So what if the absolute best way to get rich in the stock market was to do nothing? It just sounds completely wrong, doesn't it? But the data, well, it's pretty shocking. We're about to break down why trying to be some smart, active investor is often a trap, and how a disciplined strategy of just doing less can lead to so much more. This is a really foundational idea for building wealth, and hey, if you find that valuable, subscribe to Money Mindset. All right, let's start with the hard numbers.
This right here, this is the uncomfortable truth. According to decades of research from a firm called Dalbar, which analyzes investor behavior, over a 30-year period, the S&P 500 market index returned an average of 10.35% a year. Pretty good, right? But the average person investing in that very same market, they only earned 3.66%. That's not a small gap. That is a life-changing amount of money just left on the table.
So that 6.69% gap in performance year after year, it's just staggering. This isn't some rounding error. This is the difference between having a comfortable retirement and just scraping by. And here's the kicker. It's the direct result of investors trying to do better than the market through all their active decisions. You know, the buying, the selling, the switching. As we're about to see, that very effort, that's the problem.
So where did all that money go? I mean, if the market generated over 10% and investors only saw 3.6%, that wealth didn't just vanish into thin air. Nope. It was lost to two main culprits: the structure of the game itself and, well, the psychology of the players.
Okay, let's start with the game itself. The world of active investing, where you're trying to pick the winning stocks and time your moves perfectly, is what's known as a loser's game. And it's not just tough for regular folks like us. Even the highest-paid professionals on Wall Street are pretty much set up to fail.
Just look at this data from the SPI VIA scorecard. Over long stretches of time, about 80% of professional fund managers failed to beat their own market benchmark. Think about that. These are experts, people with PhDs and supercomputers, and 4 out of 5 of them can't even outperform a simple, unmanaged index. Really makes you wonder, what chance does the average person have? Vanguard's founder, the legendary John Bogle, put it perfectly. Before you factor in any costs, investing is a zero-sum game. See, as a group, all investors are the market, so their collective return has to equal the market's return. It's just math. But the moment you subtract the costs of playing, all the fees, commissions, the average return for the group must be less than the market. It becomes a loser's game by definition.
And those costs Bogle was talking about, they are not small. This chart from the SEC shows their devastating power over time. A pretty common 1% annual fee in an active fund can eat up nearly $30,000 of your potential returns on a $100,000 investment over 20 years. Fees are this quiet, constant drag just pulling your wealth down.
So the game is rigged against you by costs. We get that. But that's only half the story. The second, and you could argue much bigger problem, isn't the market, it's us. Our own brains are hardwired with these psychological biases that cause us to make predictably bad financial decisions. A lot of the time, the enemy is the person staring back at us in the mirror. There are 3 huge psychological traps we fall into. First, there's the illusion of control. This deep-seated belief that we're smarter than everyone else and we can outsmart the market. Second, FOMO, the fear of missing out, which makes us chase those hot stocks that have already gone to the moon. And finally, my favorite, panic selling. The market drops, fear takes over, and we sell at the absolute bottom, locking in our losses for good. And this creates this just disastrous cycle. When the market's on a tear and everyone's euphoric, our FOMO kicks in and we buy high. Then when the market inevitably drops, our panic response takes over and we sell low. And then as the market recovers without us, we're just left on the sidelines with regret, having missed all the gains. This right here is the single greatest wealth destroyer for the average investor. Buying high and selling low, all driven by emotion instead of discipline.
And here it is. This is the realization. The intense effort to time the market, to pick the winners, to outsmart everyone else, that very effort is what causes the underperformance. All that constant action, driven by our flawed psychology and made worse by high fees, is the source of that massive 6.69% gap we saw at the very beginning. So if trying to win is the problem, what's the solution? Well, it's a powerful, disciplined strategy that reframes doing nothing not as being lazy, but as the absolute smartest move you can make. It's about changing the game entirely.
And this quote from John Bogle is the perfect analogy for it. Instead of wasting all your time and money trying to find that one magic stock, the needle, that's going to outperform, why not just own the entire market? Why not just buy the whole haystack?
And the tool to do that is an index fund.
It's incredibly simple. An index fund doesn't try to beat the market. Its only job is to be the market. It buys all the stocks in a specific index, like the S&P 500, and just holds them. It's the ultimate do-nothing investment vehicle.
The advantages here are huge, and they directly solve the problems we've been talking about. The costs are minimal because there's no expensive manager to pay. You get instant maximum diversification, which cuts down your risk. And because the fund isn't constantly buying and selling, it's way more tax efficient. You just get to keep more of what you earn.
Okay, let's bring it all home. The evidence is just overwhelming. For the vast majority of people, the path to building long-term wealth isn't about being some genius stock picker. It's about discipline, controlling your emotions, and keeping your costs low. It's about doing less so you can actually earn more. Stop playing a game that's rigged against you. This quest to beat the market is a costly distraction. Instead, just accept the powerful, wealth-generating return of the market itself by simply owning it. That's how you win.